Stormy Waters is an excellent question. It is definitely worth your while to work out the full question and to make sure that you know and can do everything that is included in the question. What they want in this question is, it's only a 20-mark question, so therefore they cannot ask the full cash flow statement unless it is as easy as putting a pie. You have to prepare the net cash from operating activities, only that section, for the year ended 31 August by using the direct method. And then they also want you to do the reconciliation note to cash generated by operations. Good. So obviously, let's just quickly go through the question. They are numbered by, they are looking at the cash management. The accountant, Mrs. Prawn, has worked for Stormy. She's very reliable. And then they give you extract of the trial balance. Now, can you see that the format of this question is very much different from what you had in the past? There is not a long income statement. There is not a long statement of financial position. It is only this small table with balances, and the rest is all in paragraph format. So make sure that you can do that, because I love questions like that. Trading inventory, trade receivables, trade payables, shareholders for dividends, and then profit after tax. The closing balance of trade debtors as at the end of 2018 included an amount of 12,400 Rand, which was received from a debtor who has already been written off as irrecoverable in the 2016 financial year. You should immediately realize that what should they have done? They should have debited bank, which is right, but they should not have debited credited trade creditors, trade debtors, They should have credited credit losses recovered, an income item. So therefore that 12,400, if that is included in that balance there, you have to adjust that balance with the 12,400 Rand, because this shouldn't appear in that balance whatsoever. Then they also have written off actual credit losses of 10,200 Rand for the year. Now that is also in debtors. Then they tell you that total sales for the year was 2,879, of which cash sales was 367,400, and that excludes settlement discounts granted of 46,700. First semester work that you have to apply here, guys, to see whether you can do accounting or not. The company does not make use of allowance accounts, neither for settlement discounts nor for credit losses. Very important words. So when we're going to work out cash received from customers, there is some non-current assets. They give us cash paid to suppliers and employees. Here's income tax, issued share capital, and that's the end of the story. So direct method will start with cash received from customers. Now, because there's a lot of things that happened in the debtors accounts, I would strongly recommend, if you want to have the right figure, to do the T account of debtors. So let's start then with the T account of debtors. Opening balance 52,950. But the closing balance have to be inclusive of that rectification of 12,400 Rand. So the closing balance then in total equals the 87,290 Rand. Then during the year there was credit losses written off of 10,200 Rand, and that is that 10,200 Rand. Also, settlement discounts was granted. Do I grant the settlement discount on cash sales? No, guys, it is only on credit sales. So that settlement discounts of 46,700, that must have been recorded in my this account of my debtors. So very important, settlement discounts. Okay, so then they also gave us the total sales figure, but that includes cash sales. So for your debtors balance, I have to exclude the cash sales. So it is 2,879,240 minus 367,400, exclusive of the cash sales. And that will give us sales of 2511840. So now we can work out how much money have we received from our debtors, 2420600. But our cash customers, our cash sales, they're also customers. So that amount that we have received for cash sales, that we have to add the 367,400. Cash sales, 367,400. So total cash received from customers, 2,788,000. Very important, 2,788,000. Cash paid to employers or to employees and suppliers. Now they gave us that figure. They said, yes, somewhere. Cash paid to suppliers and employees amounted to 1,550,233 for the year. So I can put it in, and that will give us then a difference of cash generated from operations, 1,237,764. Great, now we have to do our profit before tax. We have to do our reconciliation note, and our reconciliation note starts with profit before tax. Now in this extract of trial balance that they gave us the profit after tax. So therefore, they also tell us profit after tax was calculated after an income item profit on the sale of the fishing trailer of 15,800 Rand was taken into account, non-cash flow item. At the beginning of the current financial year, Mr. Flipper instructed the plant manager to gain expert advice on the remaining estimated lifetime of the processing plant. The accounting policy stated that the plant will be written off over a 10-year estimated useful lifetime on the straight line method. The report issued after the investigation by the experts indicated that the remaining useful life of the plant is 5 years from 31 August 2018, and the residual value will be 80,000 Rand at the end of the plant's economic lifetime. The plant was initially taken into production on 1 September 2010 at a cost of 3.5 million, with an estimated residual value of 115,000 Rand. Mrs. Prawn has not passed the depreciation on the plant according to the new estimate, but still provided depreciation based on the old estimate. She asks you to assist her in rectifying the accounting entry to reflect depreciation based on the new estimate. Good. Now, there are a few things that comes to mind here. Number one, they gave us a profit after tax. Now, that profit after tax was calculated with the old depreciation charge included in that figure. Number 7 says, Stormy has to pay income tax at 28% of taxable income. SARS has agreed to allow them a deduction for wear and tear equal to the depreciation expense in the company's books. Provisional tax payments made during the year amounted to 285,000. There was no outstanding balance on the SARS account at the beginning of the current financial year. Okay, and then number 8 is all about the dividends and shares. So obviously, everything that affects the profit amount, the profit before tax, will be the income tax for the year. They tell us that wear and tear and depreciation is equal to each other. There is no other information which is differently treated by the receiver, like traffic fines or penalties or something like that. So we have none of that in our books. So therefore, we can assume that 680,900 that we have there equals profit before tax as in the books at that stage, with the old depreciation charge included, multiplied by 72%, 28% tax. So we would have deducted 28% tax from profit before tax in order to derive a profit after tax. So if I want to convert that profit after tax into a pre-tax figure, I'm going to divide it by 72%. and that will give us profit before taxation and adjustment entries for the depreciation of 945,694. Also remember that here 12,400 Rand worth of credit losses recovered was posted incorrectly to trade debtors, so that hasn't been rectified at all. So we have to take that income into account, and that's a taxable income. Credit losses recovered, 12,400 Rand. Now we're going to depreciate our assets according to the new method and the old method. Now, oops, this is Stormy Water here. They tell us, according to the new method, they don't give us our carrying value at the beginning of the year, so we have to calculate it. So the cost price as at 1 September 2010 was 3.5 million Rand. The estimated residual value, 115,000. So therefore, our depreciable value would be the 3.5 million less than 115,000, which gives us 3,385,000. And that was over an estimated lifetime of 10 years, if I remember correctly. The accounting policy stated that the plant will be written off over a 10-year estimated useful lifetime on the straight line method. So if we're going to calculate our accumulated depreciation as at the beginning of the year, our depreciable amount divided by 10 years, and 7 years has gone past from the 1st of September 2010 to the 1st of September 2017. So multiplied by 7, that will give us accumulated depreciation of 236,500. So the carrying value of this asset as at the beginning of the current financial year equals then a total of 1,130,500 Rand. Depreciation for the current year will be our depreciable amount, 3.5 less than 15,000 divided by 10, and that will give us 338,500. Good. We have to apply the reallocation method. So where does the reallocation method start? The reallocation method starts with the carrying value as at the beginning of the year, the one we've just calculated. And then we have to apply the new estimates on the carrying value as at the beginning of the year. Now, there is now a new estimated residual value of 80,000. And the remaining useful lifetime of the plant as from 31 August 2018. When is that, guys? That is the end of the year. So if we want to work out depreciation, what was the estimated lifetime as from the beginning of the current financial year? Not 5 years, but 6 years. From the end of the year, it was 5 years, so from the beginning of the year, it is 6 years. Very, very important. So therefore, that would have given us depreciation of 175,083. So we're going to add back the wrong depreciation of 338,500, and we're going to deduct the correct depreciation of 175,083, and that will give us then a correct profit before tax of 1,121,511. So in our reconciliation note, profit before tax 1,121,511. We are going to adjust it for non-cash flow items, of which depreciation, our actual depreciation charge for the year, has to be added back, 175,083. They also told us that there was included in that amount an amount of a profit on the sale of profit on the sale of a fishing trailer of 15,800 Rand. So that is a non-cash flow item that we're going to deduct from our profit before tax. Why deduct? Because it increased profit, so if we want to take it out, we have to subtract it. Credit losses written off. Remember that we have written off credit losses there, 10,200 Rand. So that's also a non-cash flow item. We have to add it back. Now, changes to our working capital. they gave us a small extract of balances from last year. Trading inventory, there was an increase in inventory equal to our 2,800, which represents an outflow of cash. Receivables, guys, what was the increase in our trade receivables? Now that was then the difference between 87,290 and 52,950. 87,290 plus 52,950, but then there was also, where is it now? Credit losses written off during the year of 10,200. So I have to take the 87,290 plus 10,200 minus 52,950. And that is our movement, our increase in debtors, which is an outflow of cash of 44,540. Then our payables, that is just purely last year's balance and this year's balance. There's a decrease, which also represents an outflow of cash of 5,890. So cash flow from operations, 1,237,764, 1,237,764. So it balances. Dividends paid, we're going to work that out, and taxation paid, we're going to work that out. There's no interest or dividends received or anything in this question. So if you go back to the question, the last point here was all about the dividends. The issued share capital of Stormy consists of 100,000 ordinary shares. An interim dividend of 10 cents per share was declared and paid in February 2018. At 31 August 2018, the shareholders approved a final dividend of 20 cents per share. We also have a balance for shareholders for dividends. So let's go and have a look at that calculation. Dividends, interim dividend, 100,000 rand, 100,000 shares times 10 cents equals 10,000, and the opening balance was 15,000, which we've also paid. Those dividends that was declared at the end of the year has not yet been paid. We are not interested in dividends really declared, we are interested in dividends paid, so total dividends paid then 25,000 rand. Taxation paid. Now, we have a new profit before tax of 1,211,511. If we go back to the tax note, they tell you that there was no difference between wear and tear and depreciation. They tell you that provisional tax payments made for the year was 285,000, and they also tell you that there was no outstanding balance on the SARS account as at the beginning of the year. So how much tax did they pay for the year then? 285,000 rand. So taxation paid, 285,000 rand. So net cash from operating activities, 927,764. Important, make sure that you understand this question in its entirety.